LiteFinance, the
Hello, it's Monday, December 11th, and it is of course a time to start the market forecast for this week, in which we will get the last most important macro events of this year. So stay tuned and let's go with the video. Okay, so as usual, the week begins on Tuesday, since on Monday nothing major is published. And so the second day of the week will bring us labor data from the UK and final CPI inflation data from the US. Wednesday will be the hottest day, since we will receive data about UK GDP, US PPI inflation, and most importantly, FOMC rate decision with updated rate projections. Currently, the market is rather sure the rates will stay unchanged, most likely until March 2024. So key thing is to listen to the press conference and what Jerome Powell will say and the mentioned projections, because that's what most likely will drive the markets. On Thursday, Swiss National Bank, Bank of England and ECB will publish their rate decisions, and the situation is similar to the one with the Fed, where we should focus on what chief executives will say and what we can get from the bank's statements. So week will end on a Friday with preliminary PMI data from key economies, so as you can see, this week will not be boring. Now let's move on to fundamentals. Today we are checking what is currently happening on the gold market. So the main reason for gold's rally is that investors believe the 2020-2021 story will repeat itself. Back then, the Fed had to save the US economy using large flows of cheap liquidity amid the pandemic. Rates dropped drastically, the central bank actively used QE, and the precious metal reached a record high sometime later. Something similar is underway at the end of 2023. Markets believe the Fed funds rate will decline by 125 basis points to 4.25% in 2024. This kind of monetary stimulus increases demand for securities, lower bond yields, weakens the US dollar, and draws money to the gold market. The problem is that monetary easing scale and speed expectations are too high. Investors have made conclusions based on a single inflation report and three current wars in Ukraine, the Middle East, and the US-China trade war must be financed. So high bond rates are required to attract buyers. They are unlikely to fall as much as in December, and gold risks returning to below 2,000 an ounce after market expectations of a Fed funds rate decision get re-estimated. Still, the Fed will unlikely ease policy, so I wouldn't doubt that gold will continue trending up. We will then switch from short-term selling with a target at 1990 and 1960 to medium and long-term buying. But for now, these are the targets for short trades. And that will be all from my side. Thank you guys for watching, and till next week.